Well, hello, everyone. Good afternoon. I think it's only a few panels to go for the rest of the whole token conference. Good to have you guys here with us. We're going to get into some meaty stuff. We're going to be talking about real-world assets on-chain. This is my second panel this week about this topic, and we've seen a lot of talk about RWAs on chain because I think this is where the real adoption is happening for the industry. If you haven't met me before, I'm Samantha. I'm from Yap Global. We're a PR agency specializing in crypto and digital assets. Been doing this for 8 years, and I've seen a lot of attempts for real world assets on chain over the years. I think early days they called it, STOs. Remember that term, but now it's a different tune. I think that we're finally in a moment where it's a reality. So I do want to open up the panel and just ask and talk about the state of RWAs on chain right now. What are you guys seeing as the ideal assets that are getting tokenized on chain right now? Anyone can start.
Sure, I think I'll take the first step. It's interesting, first of all, call out that we use the term RWA, real-world assets. I think these are just traditional assets. We obviously have that distinction because crypto assets seem to have its own categorization. So RWA is a very crypto term. If you tell a traditional banker, lawyer what an RWA is, they might laugh at you. The first thing for me is alternate assets. This might be tokenized bonds, corporate paper, even private credit interests, hedge fund interests. I feel like these are things that are most frequently talked about, most frequently held by high net worth individuals. So that's, I think, the top priority for me.
Mm-hmm.
Yeah. In addition, I would add, I'd say like the Mag 7 stocks and U.S. equities are a major kind of, memento at the moment, and being able to offer those types of assets to the 300 million people who have access to crypto that largely, probably don't have a Robinhood account. I think that is kind of the next step for real world assets from where we are today. And then there's a differentiator, right? Are they spot assets? Are they perps? Are they derivatives? And I think there's a lot of opportunity, within those different categories.
Yeah. Ming?
Yeah, and I would add, so I guess as a way of introduction, so I'm actually from the traditional finance world. So I run a licensed broker, FINRA licensed broker in the US called Atomic Vault Securities. And we are pretty much an infrastructure layer. So we are trying to embed the US stock market and soon Hong Kong and Chinese stock markets into the crypto world and offering a full service solution. So from my perspective, it's basically like the first step was stable coins. That's super easy. People in emerging markets want to hold USD. They want non-hyperinflation. And they want to preserve the value of their cash. And then the next step after that is they want to invest into global markets, tapping into the most liquid asset classes in the world. So for us, that's, US stocks is a very major asset class.
Mm-hmm. I want to laser into what each of you are doing. So let's start with you, Cooper. So Injective Labs is, built a cross-chain infrastructure for decentralized finance. What unique role do you see Injective playing in the RWA movement?
Yeah, I think it's liquidity infrastructure and being able to offer applications, things like, as I noted, the Mag 7 stocks, both the perp and spot side. So I think that we're building module set for developers to create applications seamlessly and then leverage those applications and get access to traditional equities and offer them in new places across the world. So that's the very exciting part of why we get to wake up and work on what we do every day.
Great. David, Drift has strong roots in high-speed on-chain trading. How do RWAs fit into the broader DeFi ecosystem that you're building and what you're seeing?
I think it does two things. One is it has an alternate set of assets. I think we're very familiar with crypto yields, it's borrow lend products, it's vol products, but all of a sudden you have this whole market of traditional products. This is private credit, everything I talked about earlier, that offers uncorrelated yield and positioning to what we currently have. So I think that's the first. Second is I think this category of like digital asset treasuries, essentially public companies, these are securities, public companies that purchase cryptocurrencies, usually one single one, and then they hold it and it just essentially tracks the balance sheet of the NAV. I think where we fit in is on Drift, and what makes us unique is largest derivatives platform on Solana today. One thing that's clever is taking these interests and using them as collateral on our platform. The fact that you can actually borrow against it for the first time is unheard of. Normally, these have zero asset weight. A traditional bank won't give you any borrowing power against that. So I think this is where this on-chain revolution starts to really take place. And I think we're at the very beginning of exploring all of that.
Mm-hmm. Ming, coming from a traditional financial background and also as a broker, a licensed broker, how do you see it play out with adoption of RWAs, like especially with what David on the very more DeFi, decentralized side?
Yeah, definitely. I think one giant problem or like speed bump that we run into in the regulated world is whenever you want to access users in a certain country, like you basically have to go country by country, jurisdiction by jurisdiction, and each time we're B2B, so each time we work with a financial institution, they have something like a couple million users on each platform because they can really only offer their products to whoever they're legally licensed to access. Whereas, venturing into the crypto side, especially on the DeFi side, you can just service clients around the world, maybe except for those that you have to whitelist out. But pretty much you're just able to access anyone from anywhere and provide services. And so the scalability factor is just like way bigger in some ways than.
And I think we were talking actually backstage about how like accessibility for anyone to really access these assets will be open for the assets on chain for anyone. Well, I mean, moving on to kind of the like more technology and infrastructure side of it, and like how it realistically is implemented. Building infrastructure for RWAs requires bridging the traditional financial world with DeFi. What are the technical foundations that make that possible? And it'd be good to hear from the panel like how you guys are doing it.
Yeah, I think we were chatting about it before, right? You have a place where price discovery is occurring for assets, and then you have market makers, that are hypothetically providing liquidity for those assets across exchange. And if they come into DeFi, I think that's the most exciting part now today.
I think this is the part where I get to completely take apart all of the solutions that are non-viable in the marketplace today. So I think the common, the common narrative today is you tokenize something. So what does that actually mean underneath the hood? It means first you have an entity that goes and issues a token that's based on a real world asset. So what ends up happening is first you take in dollars, usually dollars, from let's say a market maker or a market participant, and then what pops out on the other side of the issuer is this like, tokenized thing. And then you need the tokenized thing inside of your wallet or whatnot in order to actually make markets and trade on centralized exchange or decentralized exchange. So that basically gets into the core thing in creating any market is you need liquidity, right? And the biggest problem right now in the tokenized solution or the way it's done today is liquidity. And one of the big reasons is because you're basically creating a separate pool away from the existing very, very liquid pool of the US, let's say US market or whatever asset you're tokenizing. And you're basically forcing all of your market makers to never go short. They're either like zero at best, or they're holding on to whatever residual positions they are in their wallet or custodian. And so you basically you're handicapping the market makers in terms of their risk management. And so who's going to be willing to make markets on that? It's very challenging, and that's a currently unsolved problem. And then there's other issues, like if you want to go into the traditional US stocks world, that's T+1. Whereas everything on chain is, of course, instantaneous settlement. So what you're forcing the market makers to do here is you're saying, when you want to buy or sell something on chain, you have to pay, you have to pre-fund. But then when you sell your assets in the real world or in traditional finance world, you don't get your money until the next day. And so you basically have to post margin or post collateral doubly, and then you have to pay for that financing cost. And so what you're going to end up doing as a market maker is you're going to embed all of that financing cost into your spreads. And so then in the DeFi world or in the crypto world, the spreads are just going to be huge compared to in the regular world, which basically completely invalidates your market data source or your Oracle anyways. And then your end customer is looking at, what is the underlying price in the real world versus what is the price that I'm getting on chain, and they just feel like they're getting their faces ripped off. So that's kind of the problem with everything right now.
Yeah.
I'll take the other side, where other side is in like the exchange side. When we think about tokenized assets as collateral, well, let's use a U.S. Treasury, for example. Tokenized treasuries has been a big thing. You can get intraday yield. You can, I can send it to Sam in an instant, where normally this would take time to settle. The issue with collateral is that if there is a bankruptcy or a liquidation, I need to be able to sell that very quickly and get my treasury. The treasury is what's valuable, not the wrapper. The wrapper is actually worthless. So you actually have a level of illiquidity risk. And if the issuer goes down, what do I do? So as an exchange, you would want to apply some kind of haircut to it, because there's a level of illiquidity attached to that wrapper. So, to what Ming said, you either need to post more, or per dollar of asset, you get less purchasing power, both of which are capitally inefficient. It's like, as a maker, why would you want to be half as efficient as your peers because of a certain quote asset that you're using?
So then so it sounds like it's not that straightforward. And there's a lot of infrastructure and like innovation that needs to happen to even just make it accessible to the wider market. So how do you guys evaluate the trade-offs between, public chains, issuing assets on public chains, permissionless networks, or have a hybrid approach, particularly the traditional financial world issuing assets in the decentralized space on chain?
Well, it'd be really easy if the traditional world became T+0. But unfortunately, we don't.
But that's not that straightforward, yeah.
Yeah.
Well, to be fair, the traditional world back in like the 70s was like T+5, and then the 90s became T+3, and it was T+2, and now T+1 in like the 2000s. So we've actually evolved a lot. If you think about it, it's improved 5x. But we've come from a very, very different benchmark to what we're used to. So when you hear that kind of instantaneous settlement, it's a huge infrastructural improvement to what we know as TradFi, because that settlement window, if you're waiting for an accounts payable, that's a long time you might have to wait. If you want to settle a loan, it's like counterparty risk, but that obviously gets mitigated if you can reduce that settlement time to as low as possible. Going from T+1 day to instantaneous does sound kind of scary, because usually there's that kind of buffer. If you look at like a smart contract based exchange, we won't give you the courtesy of a call. It's like, hey, by the way, like top up your margin, please. Well, you would just get liquidated. And I think that's something that is still not, user behavior that people are familiar with just yet. So I feel like there's still a bit of catching up to do before, you can sort of enjoy the best of both worlds.
Agreed. DeFi users don't know what a margin call is, right? You're either liquidated or you're not.
Mm-hmm. How's Injective Labs seeing the implementation of RWAs? Like, what are you guys doing?
Yeah, so our ecosystem is working with issuers, and those issuers can work with the market makers integrated with the network, and then those applications can leverage that liquidity and offer unique assets to users wherever they might be. So we've seen Mag 7 stocks get a lot of traction, things like Tesla or things like Coinbase and Circle, and we've seen it in the form of perpetuals. And the liquidity comes from market makers who then can hedge or offload risk in TradFi. And we found that to be a very compelling product to really try to deal with what David had alluded to, which is double wrapping the treasuries, where you have to have capital, which is highly inefficient in two different places. So that's what we've been working very closely with, is building infrastructure for as many issuers or applications as possible, such that they can offer these types of products or applications to the end user wherever they might be.
Mm-hmm. So Ming, you touched on liquidity. You also touched on the fact that stablecoin adoption. We're seeing that, and the stablecoin market is growing. But yeah, actually a challenge to more of the DeFi folks on the panel. How are you guys dealing with liquidity? Because that's actually what also needs to be there for the market to grow.
Yeah,
Yeah.
maybe I'll just jump in on behalf of my DeFi peers here.
Yeah,
I
go
think
for it.
both of them are focused on perps. And I think that is a very strategic decision because you actually avoid a lot of the settlement problems when you're doing perps, because then you're not really waiting to receive the underlier. You're not really, like, you can just have, bilateral or OTC agreements, and then you can just counterparties can just pay each other whenever they want. And so then you can basically match up the settlement. And then ultimately, it's kind of a question that, maybe the industry doesn't really know how to answer right now, but it's, do people actually want to receive the underlier? Do they actually want the real stock? Do they really want the dividends? Do they want to deal with the corporate actions and all the headaches there? Or like, do they just really want the economic exposure? And so if you take the view that they just want the economic exposure and that's the main thing, then, perps are obviously much simpler and more straightforward to implement and you can avoid a lot of these, margin issues and, settlement issues.
Mm-hmm.
Yeah, no, I would happen to agree with all the points made.
Okay. Well, moving on to like regulation and the legal side of things, because tokenizing real world assets means dealing with, real world regulation as well. How are your different teams navigating that?
Yeah, I mean, I'm not a legal expert and we're infrastructure providers, so we really lean on applications to make those decisions. And my GC definitely will be happy with me saying that. But with that being the case, I think, specifically in the US, we're seeing a new regime and a lot more acceptance. And I think that that's very exciting for the industry at large. And that's kind of our broader perspective, is just to continue to be on the forefront of that innovation. And to work with as many teams to build these products and offer it, whether it be domestically or offshore, as quickly as possible.
I guess not legal advice whatsoever. I am a lawyer in a past life. I think things like Genius Bill, Stablecoin Act have changed like the game significantly from where it used to be. Without getting into like the technicals, it's a big unlock for people that are doing like white label stablecoin solutions. So I think like to distill it, there's like two things here. One is collateral, one is payments. Collateral and payments serve two very, very different functions. Something that is good for payments might be very bad for collateral. The example is like a tokenized treasury. Like, why would you want to have a tokenized treasury versus a regular treasury for collateral? But as a payment mechanism, if I'm sending it to someone, to a different country, different jurisdiction, that's very much far superior versus trying to wait whatever clearance time or clearinghouse window that a bank or a Western Union has to go through. So I feel like that's a distinction that needs to be made.
Mm-hmm.
Yeah, I think from a regulatory standpoint, if we're talking about the U.S. market, one of the major I guess announcements that the Paul Atkins or Hester Peirce and Paul Atkins have come out with is to say that tokenized like U.S. stocks are securities, and so it kind of goes back to the age-old question of like, every time something gets issued, like, is it a security or is it not a security? And like, does it pass the Howey test? Does it not pass the Howey test? And I feel like that's been the same conversation we've been having for the last like 5 years in crypto. But I do think that and a lot of especially folks in DeFi, the focus often starts with non-US, and a lot of it is IP whitelisting away like US and Canada and UK and wherever the regulations are more leaning towards calling certain things securities. Yeah. And so maybe like that's just where it starts, right? We prove that there's the demand. We prove that maybe we can do things a bit more efficiently than relying on 70-year-old infrastructure that frankly doesn't run that efficiently sometimes, and seeing if this can scale beyond what we've seen before in the world, and we can put it into the hands of a lot more people around the world.
Yeah, it's interesting you talk about other jurisdictions other than the US. I was on a panel earlier this week talking about RWA assets, and there was a spokesperson from DBS in Singapore, and he was talking about how they initially tokenized bonds, and they had to really be creative with creating a proper kind of structure for issuing that in a compliant way. And this is like Singapore's top bank. So actually, just looking globally, which markets do you see leading? Like, which markets do you see are positioned to lead on RWA implementation in the next 12 to 24 months? Because, yeah, it seems like it requires actually a lot of creativity and innovation with regulation and legal frameworks.
It's usually about the amount of risk you want to take. Like any lawyer will say, like, it's the role of lawyers and all this is like risk architecting. And I'll give you an example of something that launched recently. It's called X stocks. It's tokenized like Tesla, SpaceX, a bunch of other things. And the way it's actually done in the underlying is that it's a Liechtenstein SPV that holds the underlying, and then obviously it comes out the other side as a tokenized wrapper. So, looks fine. But when you think about instances of like share splits, when something happens to them, like, what happens into the token? Does the token just split? Does it halve in value? Do new tokens get minted? These are questions that we haven't really thought too deeply about. So there's, a lot of friction to even doing an exercise like that. So you just got to consider all these, like, I guess like fringe cases. In an ideal world, it just trades normally. It doesn't sort of undergo any sort of special activity. But the reality is that, this kind of stuff happens. Like, what if there's an acquisition? Does the existing token get deprecated? Like, what does that look like? How does it sort of get, redeemed for its underlying? There's a lot of sort of questions on what that all looks like. And I think, this is obviously a good experiment to see, hey, is the demand there? And is there a taker flow? And if there is, then we should get more sophisticated. So to your question on which country, I would say, usually US equities, US stocks are the ones that are most desired. As an Australian, I can't get access to it easily. As a Singaporean, equally as difficult. But if it's demand for it, then solutions will come about to meet that demand. So it's just very much market forces from there on. But the existing iterations of these are very Frankenstein-y.
So I guess like the top contenders would obviously be, all the developed countries. So looking in the crypto hubs of the world. So looking at US, certain countries in the EU, although I'm less familiar with the EU, Hong Kong, Singapore, Dubai/Abu Dhabi. And I have to give a shout out to Hong Kong. I think there's innovation happening in the RWA space in Hong Kong that is not happening across the rest of the world. And I think that there's this common notion that everyone looks to the US to be the leader. But I actually think there's a lot of traditional finance themes and patterns playing out in Hong Kong that are happening at scale and happening a lot faster than in the rest of the world. Because I think Hong Kong users, there's a really well-established class of relatively, frequent, not traders necessarily, but like lower end, like high net worth, like 1 to 10 million kind of USD range net worth traders, where they have really sophisticated demands. So they really like structured products. They really like, and the banks in Hong Kong are extremely sophisticated. They create these, we talk about like covered calls as if they're like complicated instruments. But then, you go to like SocGen in Hong Kong is creating like not just covered calls or even like equity linked notes and stuff like that, but they're creating these like knock-in, knockout, like all sorts of like weirdly shaped, like snowball, like structured products. And a bunch of those are, like RWA is, that theme is coming into play here, because there's a lot of these banks, and they're creating like, even it starts out with money market funds. That's the easiest thing. So these banks are taking their money market funds and basically bringing them on chain and putting them in the hands of not just their private clients that can access these things through the banks, but now anyone who's just able to trade these on chain or even centralized exchanges. And so I think there's a lot more communication and cross collaboration between the banks and crypto in places like Hong Kong.
Mm-hmm. That's interesting. Are there any case studies, or I know we've spoken a lot about different types of assets that are being tokenized, but any particular example of something that your organizations worked with recently?
For
to paint a better picture.
We worked with Apollo Global Management, $1 trillion asset manager. one thing they wanted to do was away from money market products. I mean, I feel like we have like 10, 15 money market tokens that kind of more or less do the same. Apollo and one of the partners decided to push out a private credit token. It's called Apollo Private Credit, Diversified Private Credit, ACRED for short. And essentially, it's all of the private credit wrapped into a tokenized asset. And I feel like the utility of that is where it gets really interesting for private credit. So for reference, private credit pays roughly 8%, 9% unlevered compared to, say, a 4 or 5% treasury rate. That gets really interesting for sophisticated holders where they can start to lever that. Can I borrow USD, USDC, and then loop that and increase the 8, 9% unlevered to like 15 to 17 to even 20%, depending on how aggressive you want to go. So we were the first platform to do that. I think first derivatives platform of any kind to enable that kind of looping. Obviously, it comes with some level of risk, and it's only available to sophisticated investors. So this is obviously security at the end of the day. But it's very obviously telling that people are going in this direction. The fact that this utility can be assigned to something like a private credit interest is huge, because private credit usually consists anywhere from 20 to 40% of a high net worth or a family office's book. So I think that's something that we've had a bit of experience dealing with early in the year.
Interesting.
Yeah, we're offering about 15 U.S. equities across our infrastructure currently, as well as we recently launched pre-IPO perpetuals as well. And there's a ton of demand across the application stack. And I think we're super excited to see that grow and continue to support it.
Where's the demand coming from?
I would say mostly from underserved places. So it's tough to track, but a lot of the time it's coming from places like Turkey, Thailand, Vietnam. So I think it's largely people that don't have access. And I think David chatted on that previously.
Yeah.
So we primarily work with kind of like traditional finance platforms, like neo brokers around the world, especially Asia. So doing something like 3 billion-ish notional USD per month and about like 150K contracts a day. And currently, integrating with crypto platforms and open to integrating with more crypto platforms, largely, and kind of, if anyone's interested could talk, but the model is largely the same as with the traditional platforms as they plug into us, because we're basically just the back end.
Yeah. So Atomic Vaults, guys, do reach out to Ming for that. All right. Well, just to kind of end on the global outlook of where we're heading, what's what needs to happen? I mean, look, so the industry's grown up quite a bit. You guys have already shared that you're already, issuing quite a number of different, RWAs on chain. What needs to happen for it to really take off? I mean, we're at this, I think we're in this year where stable coins have really had their moment. That's taking off. And so I feel like that's the baseline for growing more liquidity in the space. So what's next? Like, what needs to happen next?
Yeah, my quick tip would be like account abstraction and effectively making the actual UI UX for these products very seamless. I mean, it's the basic answer, but I think it's the reality. Downloading a crypto wallet, going through all these different types of things to get to that end product is really a crypto native thing that probably only people in this room will do, but the guy outside won't. And I think that, working with the product stack that we have and optimizing all that tooling is probably the most important part to see the 100x that we've seen in stablecoins. Okay. I think we've seen that in stablecoins because we have legacy businesses integrating stablecoins into real products where you don't feel the crypto friction. So I think once we get that for these forms of applications that are leveraging this infrastructure, then you'll really see the big pickup.
Yeah. I think there's different parts that can use a lot of improvements in order to unlock more volumes. So I think the biggest bottlenecks right now are, I think probably on the user side, it's still trust, because it's kind of this delicate play between what's the leverage level that we need for users to feel like, I'm putting in the amount of amount of money that I want to get the outcome that I want. But at the same time, I don't want to be taking like way more risk than I necessarily thought I was, which is, I think, a big problem in the CFD world, for instance. And so there's a like very low trust in the CFD world. So I think that's one challenge to adoption, is if you take a synthetic or CFD or kind of like perps approach, is hitting that equilibrium in terms of customer demand, customer retention. And then on the market maker side, I think liquidity is still a huge problem, kind of going back to that as a core issue, because market makers need a way to hedge. And so that always just, when you hedge, you have to go back to the traditional finance world. And so that bridge right now is just highly inefficient. So we have to build a better bridge, essentially.
Yeah, definitely want to piggyback on that, because that is the biggest pain point from my perspective here as well. Like some of these folks, they can't even get accounts at interactive brokers. They get turned away. So I think that, there's a lot of friction when finding those places to hedge. And that's got to be sorted out before anything, improves significantly.
Yep. So improved bridging for the liquidity to flow. Anything else to add there, David?
I think, maybe talking, I think, my fellow panelists have spoken about UX really well. I think on the more sophisticated side, private placement fund side, which is where I'm a bit more familiar with, it's just the current formation of tokenized fund products are really just taking existing fund products, putting in a electronic wrapper, and then posting it out. But the rules are the same. You have to still adhere to redemption windows, which is, you can only redeem 90 days. You have to give notice period 90 days. So to actually exit an Apollo private credit token, it's the same as the underlying product, and that offers no marginal benefit. Yes, you could say there's looping, but there's also, costs to that. So I think that needs to be a convergence for, maybe a different set of rules. Like this needs to be built for the purpose of, being default tokenized versus like tokenizing as like a feature of a product. And that hasn't taken place yet. So you're seeing a lot of frictions, a lot of middlemen, people that provide that service. Eventually that's going to go away. And eventually it's probably going to be a bank that like does all of that. But in the interim, it's still very much this sort of mirrored synthetic type of approach. So, we sort of covered tokenization, but also just like, what perps do is just, it's a synthetic position. So, some of these tokenized products very much just look like some form of mirroring where the underlying is held elsewhere, and you essentially issued a receipt of a token that could be redeemable for like 1 unit of a certain stock or product.
Mm-hmm. So we've spoken about the frictions. I don't know, this may be like more of a guessing thing, or maybe you guys have more of an informed view of this, but what's the realistic timeline for RWAs to reach a meaningful scale in global capital markets? And yeah, if anyone has a view on what a meaningful scale looks like.
Yeah, I mean, I think there's 30 billion non-stablecoin real-world assets out there today. Last time I looked, I think yesterday, and yeah. I think that number's got to get to at least $1 trillion, hopefully, right? Because the bips that people make off these things are so small, and I think there's a very large opportunity in the next 2 to 3 years. And I think that we'll have to wait to see if we have that pickup from retail. Or actual users, right? All the people in the room can love it all they want, but until the average person has a reason to utilize the platform, which I don't think that there's as many compelling reasons today, and that's what we're trying to work towards and continue to support. We won't get there. So I think that we probably have a 2 to 3 year window to work really super hard at it, and hopefully we can get there.
Great.
I'm going to say what everyone in the industry is thinking, but maybe not everyone is saying, which is,
go for it.
It doesn't matter. We got to get there in the next 3 years.
Yeah. Agreed.
We have to. That's what everyone's thinking and everyone's trying to do, is just push with the next 3 years, because who knows what's going to happen after that.
Yeah, let's do it. Yeah.
I'll give a bearish contrarian take. I think it's going to take a lot longer than we think, because, the standard for how this world operates is still very much reg first. If the reg doesn't like a certain thing, then that affects the builders, the entrepreneurs trying to push that boundary. So as long as you have that innate resistance, it's going to be very, very tricky. So right. I say that with very much like a risk hat on, everything in 2-3 years. I think I'm going to be a little more practical here.
But I have to say, we do have 2 to 3 years with a more positive U.S. Government in place. So let's see what can happen in that time frame. But yeah, could the audience please give my panelists a round of applause? Thank you guys for your insights. Yeah, been great chatting about this. Awesome. And that wraps up the panel. Thank you guys.